Jim Munchback here, about to start a new lesson at the University of Houston, personal finance. First, I have to open up the Zoom app and get going. I apologize, I'm having some technical difficulties. I'm really not sure what's going on. I'll have to figure it out later, but I'm going to go ahead and admit the students who are waiting. If you're joining us on uh, Facebook or the YouTube, welcome aboard. Happy day after. Welcome everyone in Zoom. If someone could please give me a sound test, just let me know you can hear me. I appreciate it. Welcome. Can you hear me? I must be muted. Okay, great. I can hear you too, Yen. Thank you very much. Okay, we're going to start talking about investments today. I'm going to give everybody a few more minutes to find us, to join us. I'm assuming that today, since it's a day after a national holiday, the 4th of July, Independence Day, today is July 5th, 2022, and I'm assuming that there are some students who are still unavailable. Um, uh, I'm getting some requests. Well, I got one request to extend today's due dates, but it's summer school. Summer school is a rapidly fast moving, fast paced course, and I'm sorry about that. So I'm not really, unless I get some more input and it really becomes necessary. If it's just a couple of students who weren't able to get the assignment done, then I don't feel like that's a fair thing to do. But we'll see. It is summer school, though, and it is a challenging session because we go so fast. So we had two assignments due today. If you have any questions or comments about those assignments, you're welcome to post those in the Zoom chat. So I'm going to get started here in just a minute. I'm having some technical difficulties. Usually I use my iPad to display, but for some reason the tool that I'm using is not showing my iPad. It's either a bad cable or something. I'm not really sure. So I'm using secondary screen, which I've never done before. So hopefully you're seeing it okay, and hopefully I can do what I need to do. So we're going to talk about investing. We talked about insurance last week briefly. Because it's summer school, we have such a short time to actually deal with insurance. Insurance is one of those topics that we could spend an entire semester talking about. And I certainly could talk about insurance for an entire semester. It's unfortunately one of the topics that I would be considered an expert in. It's also one of the topics that most people would think is probably a very boring topic. I actually think it's pretty interesting because I've got lots of experience. I was a fire claims adjuster for many years. I have a lot of letters after my name, and my expertise was in special investigative unit, is what we called it. It was basically fraud, and so it required a pretty high level of intensity in terms of investigating claims, losses. That's probably where I had the most experience, but I also had experience at State Farm, which was really a cool place to work. I'm not so sure it's a cool place to work anymore. I've talked to a lot of my friends who worked there for years and retired, and just got it changed a lot. State Farm changed over the years from the time I joined back in 1989. But at any rate, I was a trainer. It was called a re-inspector trainer. So I got to travel all around the country and train adjusters who were working catastrophes, primarily hurricanes, but also earthquakes and fires and floods. The, every kind of catastrophe you can imagine, and property claims, especially if it affects a home or a car. Those were the type of events that I would go around the country and train people. And eventually, I became a State Farm agent, and that I left the claims department as an employee and went out on my own and became a State Farm agent, which is an independent contractor, not an employee. And so in that role, I also got my independent adjuster's license. So to this day, I can handle claims anywhere in the country. And when there's an event, like Hurricane Katrina was a big event, Hurricane Harvey in Houston was a huge event. When those things happen, I can pack my bag, drive my RV to the location, get a pile of claim files, and start adjusting claims for whatever company has the highest fee bill. So I've made a lot of money doing that in my career as an independent adjuster, kind of a side hustle. But it's been a fun job. I really enjoyed it, and I've got to teach a lot of people how to do it. I've got some really, that's why I say I think insurance is very interesting, because I have a ton of stories about insurance. And typically in this course, I like to spend I spend at least a whole session telling stories about insurance so that you can better understand the coverages. And so I've posted some of those videos in Money Study Group and in other places. And if you're interested in learning more, those stories can be helpful. But we just don't have time during summer school, because we're banging out these lessons and these assignments and everything pretty quickly. I'm going to move on. Unless you have questions, if you're here in the Zoom meeting, or if you have questions on Facebook or YouTube, go ahead and post those questions, and I'll try to come back and get you an answer. So here we go. Like I said, I'm having a little technical difficulty now with my mouse, which is weird. So I'm going to just try to jump in. I want to start out talking about the perfect investment. And I don't know about you, but you might ask, what is the perfect investment? And usually when we're in class, I ask the question, if you had to pick something and say it's the perfect investment, what would you think of? And so I've got lots of answers over the years, and so I'm going to ask you that question too. If you have an answer, just give me an answer. I'm looking. Sorry, I'm having so much trouble with my mouse. Using two screens is different. So now I'm looking for chat, and I'm not finding it because I'm on two screens and I don't know where the chat is. So I'll just say, if you have a question or a chat, instead of chatting it in, you may have to just unmute yourself and speak up, and I'll be happy to answer your question. But right now I'm not finding the chat box, so I'm just going to keep going. These articles, by the way, that I'm looking at, that you're seeing, they're posted. I posted them this morning at missionalmoney.com, so you can find them easily at missionalmoney.com. Just scroll down and go to the posts. I post these on the website at missionalmoney.com because this is where I do the podcast, but it's also it's easy for me to be able to grab it and put it on the display and discuss it during the assignment as we prepare for our assignments at the University of Houston. So you'll see the same information when you go to Money Study Group, and when you get to your Blackboard assignment for this week in investments, you'll see very similar content. But what I want to do in terms of investments and starting out the conversation about investments is I want to kind of set the table. And so I'm going to set the table today by talking about the perfect investment. I'll talk about that first. And then I'll talk about types of investments, because it's really important as I get into the third section, which is 4 investment strategies. This is really the key part of today's lesson, 4 investment strategies that are designed to help you as a younger person with a long time to invest. These 4 strategies are designed to help you maximize returns and minimize risk over your lifetime. And these are 4 investment strategies that absolutely work. And so I want you to walk away from this course with a very special skill for investing. Special in terms of really having the confidence to know that you can put into practice the things that you learned in this course that can really move the needle in terms of your financial life. And so these 4 investment strategies, that I want to teach you kind of require a little background, a little basic understanding about investing. And so that's what I'm going to talk about. And that's what you're going to do this week in terms of your research and your reading and your preparation and even your quiz and your homework assignment. You're going to be doing basic research into investing, basic investment principles. So let's get started. So we start off with the perfect investment because it's kind of where the rubber meets the road. I've met so many people over my career as a financial planner who miss this. Okay, so I don't want you to miss this. I want you to be prepared to take advantage of the perfect investment on day one when you get your dream job. Okay, after you graduate from college and you start working, there's this opportunity that you're going to have that I call the perfect investment. And very simply, it is investing in a 401k plan. Now, you may work for the government, you may work for a nonprofit, and those plans would have a different number. But basically, 401k is the paragraph number for the IRS code, and it basically identifies the rules, boundaries, and limitations related to a type of account. The type of account is called a 401k. So you've heard of 401k, you've heard of 401k rollovers. Well, a 401k is a company plan that's designed to help you save for retirement. It gives you certain benefits, and they're very good benefits. And that's what I want to just cover briefly. I want to cover the perfect investment multiple times this semester because, again, my goal in introducing you to the perfect investment is to have you be prepared on day one when you start that job and you meet with HR, human resources, and you sign the paperwork that gets you started during orientation. Everybody goes through orientation when you start to work for a company. And during that process called orientation, typically with HR, you're given a bunch of forms and things that you have to sign, and you get introduced to where to park and where's the bathroom and what time is break and how do your vacations work and all of that stuff, including your benefits package, which very often, hopefully, includes your 401k plan. So the thing I want you to be very confident about is that when you see that, you can get excited and you can know, yes, I'm going to participate in the 401k plan. And in this small introduction to the perfect investment, this introduction to investing, using the perfect investment, I want you to know how to invest in your 401k. So let's jump down. It's the 401k match. I want to tell you how that works. So a 401k match, that is the perfect investment. I'm going to give you an example. Let's pretend that you go to work at Shell Oil. I don't know for sure what Shell Oil is paying in terms of their match, but let's say that they're very generous and they give you an 8% match. And let's also assume that you are making $100,000 a year. Let's keep this example very simple. 100,000 is a very round number, and you're making $100,000 a year, and Shell offers you, your employer offers you, an 8% match. So when you sign up for that 401k, you need to understand that 8% means the company, Shell, is going to match your contribution. The only way you're ever going to get that 8% is $8,000 because 8% of $100,000 is $8,000. But the only way you can get that $8,000 is if you choose to participate in the 401k and you actually contribute $8,000 in the year into your account. The type of account, again, is a 401k, and the company then will match it. So instead of having $8,000 in your 401k at the end of the first year, once the company matches that 8% contribution that you made, you will have a total of $16,000 in your 401k. Now, I want to rewind and kind of review what we talked about in some assignments and lessons previously. One of those was the 7 baby steps that Dave Ramsey talked about. One of those baby steps, like the last one, well, the sixth one, I guess, there are 7 of them, is to save 15% for retirement. I believe that's what it is. Hopefully, you can go back and review it and just Google Dave Ramsey's 7 baby steps. It's very popular. It's helped a lot of people get out of debt and build wealth. Very simple, very, very simple plan, if you will. And so one of those is to save 15% for retirement. Now, a lot of people will tell you, or a lot of people believe, that would be very difficult to do, to save 15%. And so I just want to kind of help you recognize as we move forward that doing that, saving 15% towards retirement, which may sound like a really difficult thing, if you use this strategy, the perfect investment, it automatically kind of takes this one and checks it off the list, because look at this. Now, 8% is a really generous match. You're probably not going to get 8%, but I use the 8% because some companies do match 8%. And at one time, I think Shell did. But the point is, if you take advantage of this matching through your 401k and you contribute at least as much as the company will match, in this case, you're going to be saving 16% towards retirement. So that baby step that Dave Ramsey mentions that is so important and seems so difficult now becomes very, very reasonable and easy to do. So I want to just kind of point out a couple of other benefits, why I call this the perfect investment. Number one is because of the match. That's huge. So get the match. You can only get the match if you sign up and contribute. So do that. So I'm going to see if I can expand this a bit. I don't know if it's going to let me. There we go. I made it bigger without screwing up the display. Boom, I made it even bigger. Okay, so I want, if this was on my iPad, by the way, I could just pinch it and expand it. That's why I love using my iPad, but today I'm working at a disadvantage. So let me get that in the center of the screen, trying to avoid showing you any marketing stuff from the site. But the 401k match, the perfect investment, involves the match, but it also involves a tax deduction. So one of the things one of your assignments that's coming up in the context of investing is, so remember the 3 laws of personal finance. The second law is the law of tax advantaged investing. The IRS makes the rules. Your job is to take advantage of them. It's called tax advantaged investing. And this perfect investment is absolutely in the center of tax advantaged investing. And the way that it works, very simply, is when you're using tax advantaged investing, you're investing in something that's giving you some kind of tax benefit. And we call it a tax deduction. In a 401k, that $8,000 that you contributed to your 401k becomes a tax deduction. Do you know what that means? A tax deduction. If you don't know what that means, you may want to Google that, read it, think about it, and tattoo it on your forehead. I was born on April 15th, and my first child, my first son, named JR, James Ray Jr., he was born on December 31st. So in my case, because I was born on April 15th, I believed it was my calling, my duty, my destiny to understand tax deductions. Not really, but I was born on April 15th. My first son was born, my first child was born on December 31st. And what that meant at the time, I believe it was I want to say it was a $6,200 credit for a child. It was a pretty big credit. It was huge to me because it basically was a top line credit on my tax return. So they gave you the money on a credit. It's actual money. And so not just a deduction, but it's a deduction. Having my son on the last day of the year gave me that tax benefit for the entire previous year. So that's a tax deduction. And that's how it works in your 401k. When you contribute to your 401k, you get a tax deduction. So now, instead of the IRS looking at your income tax return and saying you made $100,000 and you owe taxes on $100,000. They say instead you owe taxes on $92,000 instead of $100,000 because you contributed $8,000 to your 401k and you got a tax deduction. And then the company came along and matched it. So it's two big benefits. And again, we talked about the 15% baby step, and the $100,000 example that we're using is simply a way for us to try to help you recognize the benefits and put it into context. So that's the perfect investment. Now let's see if I can get some investment basics to show up. Let's talk about some investment basics. And then we're going to talk about investing 101. And that's what we're going to talk about. Let me just show you. Again, these are each 3 different posts that I tried to separate to highlight what we're going to talk about in each section of today's lesson. So this is the one we'll get to in a minute, the 4 investment strategies. So that's coming. No secret, those are the 4 investment strategies that I'm going to go over with you. These are the investment strategies that are designed to help you maximize returns and minimize risk. Diversification, asset allocation, dollar cost averaging, and portfolio rebalancing. You want to learn these terms. You're going to want to become familiar with what they are. You can Google them. You can watch videos on YouTube. I promise you, these are important investment strategies that if you learn how to use them, and you will in this course, I'm going to teach you today how to use them and how to put them to work. If you put them to work in your investment program, over time, these strategies will help you build wealth. They're proven to work. And the younger you are and the longer you have to invest, the more appropriate, applicable, and powerful these strategies are for you. And that's why I teach these to you in this course. If you were my age, I just turned 60, we would be talking about different strategies because we would need different strategies once you've accumulated your $1 million net worth and you're now investing this larger amount of money. The strategies that you use to manage the risk and the reward in those types of accounts, those size of accounts, is very different. But as you're building wealth, these strategies absolutely work. So I'm hoping and I believe that if you listen, if you pay attention, and if you learn these, you will have a lot more clarity about how to invest, which will give you more confidence in knowing that you're doing the best thing you can possibly do for yourself. And I believe that will give you more contentment in your financial life, because if you're confused and you're feeling uncertain and you have no clue, you're going to be anxious, and that's kind of the opposite of contentment. And so my hope is that you can actually experience some peace and enjoyment in your life because you understand how money works and how investing works. So that's coming. Now, if I can get my mouse to go where I want it to go, we'll talk about some investment basics. And these basics are really necessary if, in fact, you want to understand the 4 investment strategies. You need to understand a little bit, a few basic things first. So I'm not going to spend a lot of time going over these. I'm just going to mention them. So money market, it's like cash, okay? And it's an important piece of any portfolio, especially today. If you have a lot of money, it's good idea to have a pretty good amount of it in cash right now because of all the uncertainty in the market. But it's a temporary thing because one of the biggest risks that we have, if you've heard of inflation, then you'll understand that money market, cash, while they have an important role to play in the investment strategy game, inflation is a powerful, destructive force with any investment. So inflation means that your money is worth less and less because inflation is going up. And it's really hot right now. If you've been watching the news at all, you know that inflation is higher than it's been for 40 years. I told this story earlier in the semester, I believe, about when I purchased my first home was during a time of high inflation. And my loan was 11.5% on my mortgage. So think about what mortgage rate you were able to put on your loan when you did your research to purchase your home a couple weeks ago or last week. So imagine if you had to pay 11.5%. And that was a good deal because at the time I lived in Austin, and Austin had made available this large bond for first time home buyers, which I was. My wife and I had never purchased a home, and we couldn't wait to buy a house because the prices just kept going up and up and up, and interest rates were going up and up and up. And we were so afraid of not ever being able to afford a house that we just couldn't wait, and we bought a house that turned out to be a disaster. And we got this loan, this money that was made available through Austin, 11.5% interest. But again, a lot of people paid a lot more than that for their mortgage loan. So we've gone through several years where mortgage loans were so low, 2%, 1.5%, 3%, and now they're 4, 4.5%, 5%, and they're probably going to go up. But the point is, inflation, the cost of things, is going up. And that's an important part of a financial plan. It's an important part of investing. And that's why money markets and cash, they don't grow. Yeah, they're safe. They don't go up. They don't go down. But inflation is the thing you have to think about. So let's see. Liquid asset, that's another thing you're going to want to think about and understand. Basically, liquid assets just mean you can access them. You see my screen or my mouse on the screen, don't you? I just realized I'm realizing why I'm having technical difficulties. Sorry, I get distracted easy too. So anyway, in this post, we've got just some things that I want you to be aware of. Let's talk about asset classes. So asset classes are really important to understand. And typically when we're together, I would ask you, do you know what a large cap stock is? I'm going to let you think about that for a minute. An asset class is an important part of investing. You really need to understand an asset class because when you sign up for your 401k, after you decide how much you're going to put into that account, one of the next things you have to decide is how are you going to allocate those assets. And you're going to see choices when you sit down with HR to sign up for your 401k. And those choices are going to be based on how do you want to invest the money that you put into this account. So now we're talking about investing. The 401k, the perfect investment. So far, we've just talked about a type of account with certain benefits, tax benefits, and contribution limits and matching funds. But we haven't talked about investing. But you at some point have to decide how are you going to invest in your 401k. You could put all your money in the money market and have no risk at all. In 20, 30, 40 years from now, you would have what you put in your 401k. The problem is inflation would have made the cost of everything, including a house, a car, internet, computers, double, triple, quadruple. And the price of things will go up. And so if you put everything in cash, you're going to lose money because of inflation. So how are you going to invest it? So if you invest in a large cap, that's a large capitalized company. Think of Apple, Coca-Cola, Shell. Those are large cap companies, very large. We call them blue chip. My favorite investment of all time is the S&P 500. That is 500 of the largest companies in the United States, the largest 500 companies. And they happen to be the largest 500 companies in the world. And so you can invest in the S&P 500 and you would be investing in large cap. Specifically, you would be investing in U.S. large cap stocks. So that's one asset class, is U.S. large cap. And to do that, the best way to do that is to invest in the S&P 500. And at some point, I'll show you. I can't right now because I don't have my iPad working. If my iPad was working, I would click on the app that I use for investing, and I would show you my favorite investment, which is an ETF, an exchange traded fund called SPY. So you see down here that we're distinguishing between different types of investments, but we have to start with asset classes. So just know that there's a difference between a large cap stock and a small cap stock. Which one do you think has the most risk? Which one do you think has the most opportunity for growth? Do I see or hear a question, a comment? So if you, Yen, did you want to say something? That's exactly right. That doesn't mean that the large cap don't go up and down. But you're absolutely right. The small companies have more opportunity for growth, but they also have more risk because a small company could go out of business more likely than a very large, well established company. But that's the way risk and return works. If you're willing to take a little more risk, it's because you have a greater opportunity for returns. And if you want less risk, then you have to sacrifice a lower opportunity for returns. And that's what happens with large versus small. This is also what happens when you look at international companies. International companies typically have more risk, but they can also have more opportunity because emerging markets are opening up. New companies are starting in areas where they didn't have that product or service before, and so there's risk and there's return, and they usually go hand in hand, but they're like correlated, and so that the more risk you take, the more opportunity you should get, and the less risk you take, the less return you're probably going to have. But that's why it's important to understand these different asset classes, because then we get into different types of investments. And then we can talk about mutual funds, index funds, ETFs, individual stocks. And I just want to try to make you familiar with these distinctions because we started out talking about a type of account, your 401k. And if you pay attention, you'll notice that a lot of people call a 401k an investment. They also call their IRA or their Roth IRA, they consider them investments, but they're not investments at all. They're types of accounts. And so you have a type of account, and then you have to decide how are you going to invest in that type of account. And in your 401k, typically your options are going to be more likely to be asset classes. So you will say when you sign up for your 401k, you'll say, I want to put 30% or 25% in large cap. Let's keep it simple, 25% in large cap, 25% in small cap, 25% in international, and 25% in bonds. So that would be a very simple yet uh, kind of a good way to allocate your assets. And so that's why you need to understand asset classes, because when we talk about the four investment strategies, remember, we're going to talk about diversification, asset allocation, dollar cost averaging, and portfolio rebalancing. And what we're talking about when we talk about diversification, we're talking about not putting all of your eggs in one basket. So you don't want to invest everything in one stock or one company or even one asset class, because that would not be diversification. And diversification helps you prevent too much risk and it helps you build wealth. But asset allocation, that's a little different. With asset allocation, you will automatically have diversification. But the beautiful thing about asset allocation, and the reason that it's one of the most important investment strategies, is because asset allocation is the single most important determinant of your portfolio's returns. So let me say that again and again and again. Asset allocation is the single most important determinant of your portfolio's results or returns. Asset allocation is key, and you can't really do asset allocation if you don't understand asset classes, because that's what you're doing with asset allocation is you're allocating your investments to different asset classes, and by doing that you're automatically diversified. And so that's why we start with asset classes. And then we have to distinguish further between asset classes, and we have to talk about types of investments. And so an asset class is not really an investment, but it's a category of investment. It's an asset class. When we talk about types of investments, though, now we're getting into things like a mutual fund. And so there's a mutual fund, an index fund, an exchange traded fund. Those are three different funds that I would like for you to know and understand. But I'm not going to spend a great deal of time going over them. I want you to do a little research and understand the difference. They're, they're very different. I want to say they're very different. They have important distinctions, important differences. So, those three types of funds, and then we get into individual stocks, individual bonds. But let's talk about the three types of funds briefly. A mutual fund, that was like the first fancy new way to get diversification, investing in one investment and having diversification. And with a mutual fund, you get, let me see, I think I have an illustration. Maybe it's a good time to jump over here. Yeah, this is a good illustration. So this is the way that I illustrate a mutual fund. So with a mutual fund, you invest in one fund and you get diversification. So what you see there is on the left is an elevator. This is two elevators. I call this the elevator illustration. This is back in the day when I first started, when I got my securities license. I was a little clueless and I wanted to learn. And I had a friend who was an Edward Jones broker, and he was just around. He was in the same building I was in as a State Farm agent. And so we would spend time, and I called them fireside chats, because I would ask him questions about investing, and he had the best stories that helped communicate to clients what we were doing in terms of investing. And this was his story about diversification. So on the left side, you have an elevator with one cable. That would be like investing in a single company. You can think Apple or Tesla or Amazon, any one company, or Enron. And if you invest in one company and that company has a major problem, the cable, that one company is represented by that cable, you could crash and you could lose everything if you're not diversified. So that's one company. Now, if you invest in a mutual fund, that's like on the right side, you see all those cables there. Those are different companies. And what you get with a mutual fund is you get a manager, and his job or her job is to inspect those cables, those companies, and pay close attention to their strength, their weaknesses, and replace them from time to time with different companies that have a better opportunity for growth and lower chance of failure, like the cable on the left. So that's what you get with a mutual fund. You get automatic diversification, but you also get a manager who's picking and choosing your stocks inside of that fund, and you pay a fee for that. You pay a fee for that. And so mutual funds were great 30 years ago when I started investing. They were the best thing around. But then, because of the fees for those managers, what happened is people discovered that if you could just invest in the market, you could get the returns of the market. And the returns of the market almost always outperformed the managers who were picking and choosing stocks. And so they came up with a new kind of fund. Instead of a mutual fund, they evolved into what was called an index fund. An index fund is basically the same thing as a mutual fund, except it's investing in certain asset classes without having a manager picking and choosing individual stocks. So again, think about the S&P 500. You could invest in an S&P 500 index fund, and you basically had very, very low fees, but you got the exposure to the S&P 500. You could also invest in an index fund with small cap, or with bonds, or with international. There were all these different index funds you could invest in that had lower fees, no manager. The problem with a mutual fund and an index fund is that, for example, if you decided to buy a mutual fund, so this morning the market opened down. I haven't looked at it in the last 30 minutes since I've been here, and I don't want to because it's painful, but it was down almost 650 points, the Dow, and the S&P 500 was down about 1.5%. So today might be a good day to put some money to work. If I have a bunch of cash for myself or my clients, I might want to go and put some money to work. And if I did that, if I went in and made an investment this morning while the market was really bad, if I invested in a mutual fund or an index fund, whether it's large cap, small cap, international bond, whatever asset class that index fund is designed to track, if I invested in it this morning because the market was way down, what's the market going to be like at the end of day when the market closes? We've seen such volatility lately. Some days in the morning it could be down 650 points, and a little bit of good news could come out, and the market could close up 500 points. That's a 1,100 point swing on the Dow. That's what people watch, the Dow. Same kind of swing on the S&P 500. That's like a 4% swing from the morning to the afternoon. And if I bought a mutual fund or an index fund and I purchased it this morning because the market was down, it doesn't really matter that the market was down this morning, because my purchase, even though I placed it this morning, will get the price for the end of day. So instead of getting that bargain that I wanted to get in the morning because the market was way down, I instead purchased that same investment with a 4% increase in the time that I placed my order. Does that make sense? So that's one of the drawbacks about a mutual fund and an index fund. And that brings up an exchange traded fund, which is my favorite type of investment vehicle. An exchange traded fund trades like a stock. So what that means is if I place that trade in the morning, the SPY is my favorite investment on the planet. It's the ETF exchange traded fund that tracks very closely the S&P 500. So if I bought that in the morning when the market was down, the S&P 500 was down 1.5%, I'm getting that investment at a 1.5% discount from where it traded on Friday. Does that make sense? That's an ETF. That means I'm getting the price at the time that I trade it. So then if I want to sell it at the end of the day when the market swings up, I can sell it and actually make a profit in one single day. That's called day trading. That's not something I recommend, but it's to illustrate the distinction between a mutual fund and an index fund and an ETF, an exchange traded fund. So it's just something I want you to know about different types of investment vehicles. With a mutual fund, you're paying a pretty good fee to the manager to pick and choose stocks. With an index fund, you get a lot lower fee and you're getting exposure to the market to whatever asset class you want to get exposure to. But those two both trade at the end of day values. Or you could invest in an ETF, an exchange traded fund with really low expenses, and they trade like a stock, so you get the price. Not only that, but you can trade options on an exchange traded fund just like a stock. And that's a whole nother level of investing knowledge that you probably don't need at this point in your career. But it is a very important reason why professional money managers really like exchange traded funds versus mutual funds and index funds. But it's important for you to know that they exist, these types of investments, because I want you to feel confident about your investing knowledge. So that's one of the things that you'll be tested on in your quiz is mutual fund, index fund, exchange traded fund. So that's pretty much it for the things that you really need to understand to put in practice these 4 investment strategies. So let's talk about the 4 investment strategies. And these, again, they're designed to help you maximize returns and minimize risk. And I'm going to just name them again so that you can get them fixed in your mind. You should remember these. It will be easy to remember these. Diversification, asset allocation, dollar cost averaging, and portfolio rebalancing. So diversification, I'm just going to tell you a story. I already told you the story about the elevator, but I want you to think about one of the stories that I posted in Money Study Group is the Enron investors. I don't you're younger than me, so you may not remember, most of you, Enron. But Enron was a company that the stock just kept going up and up and up. And people that were investing in Enron were expecting great returns quarter after quarter after quarter. And people, as people usually do, when there's an investment that just keeps skyrocketing, people keep piling in and they pile in. And you would think that the higher it got, the less people would want to pile in, but that's not the way it works. Typically, people just keep piling in. But then one day, there was a little issue with Enron and their accounting and their their quarterly numbers didn't come out just right, and the stock dropped, and it dropped pretty bad. And at that time, the company leaders at Enron pulled the employees together and said, hey, listen, we know we've had a rough patch here at Enron, but we believe there's never been a better time to invest in Enron. So the people, I knew two people, I had two clients who worked at Enron. One of them, his name was Bill, and the other, her name was Andrea. And Andrea, she took advantage of this idea of diversification. When we met to work on her financial plan, she was very smart and she made good money at Enron, but she understood that her Enron stock was separate from her 401k. I mean, it was part of her 401k, but she didn't want to have all of her money in Enron stock. So she had a little bit in Enron, but mostly she diversified. So that what happened next with Enron when they went to zero almost, she wasn't hurt that bad. She ended up losing her job because everybody lost their job, but she was able to get another job pretty easily, and she was pretty well off because she'd saved a lot of money at Enron, but she was diversified, meaning she didn't put all of her money in Enron stock. Bill, on the other hand, he made a lot of money at Enron, and he put all of his 401k in Enron stock. It was well over $1 million. And his wife, Eleanor, she watched as Bill actually, he ended up dying of a heart attack. And it was related to stress and anxiety because Bill watched he put all of his money in Enron stock, and he watched it just collapse to nothing, and then he died. And Eleanor was now a widow, and she was a housewife all of her life, and she didn't have any marketplace skills. So she started working at a school. She worked with my wife, and she didn't make a lot of money. And she had to do that because she didn't have any retirement funds available because they all got kind of evaporated with Enron. So those are two stories that are in my heart, in my schema, in my history. And they come from Enron. And there's thousands and millions of stories like that that relate to diversification. So my hope is that you'll take heed when we talk about this particular investment strategy. It's really an important investment strategy. No matter how good the investment looks, no matter what your friends tell you about this investment, maybe put a little bit of money in it, but don't put be very careful about how much you put into any one investment, and be diversified. That's strategy number one. Asset allocation, like I told you before, asset allocation is the single most important strategy because it's the one that determines your portfolio's returns. And so the way I like to think about asset allocation, and this is a chart of a bond fund. I don't know why I have that there at the moment. It seems a little out of place, so I'm just going to go on down to this. This is the statistic I wanted to show you. So somebody did this study, Brinson. I think they were attorneys, but anyway, analysts. They determined that 94% of performance was determined by asset allocation. So I think of it as asset allocation. That's a spinning tire. I used to be a master mechanic, and I balanced thousands and thousands of tires on a machine just like that. And what happens is that tire, it they're never perfectly round. They're never perfect in terms of balance because there's, parts of the tire have more rubber and parts have less. And so when they spin, they can really vibrate. So I think of a portfolio like that. If you've ever seen a pie chart with a portfolio, you're looking for asset classes to be somewhat in balance. And asset allocation, to me, that's what makes sense. If you have good asset allocation, your portfolio will be have it will be well balanced. So that's my picture for asset allocation. I hope that helps. The next strategy is dollar cost averaging. I'm going to spend a few minutes talking about this one because this to me, let's see, I have a chart without all the writing. So again, this is posted at missionalmoney.com. You can go and see. I'm going to talk through all those scribble marks and help you understand how dollar cost averaging works. But I'm going to use this blank chart right here. Both charts obviously are on the website with, I think hopefully I put the correct information about the cost of each cow. But dollar cost averaging is an investment strategy that, in my opinion, is the most powerful investment strategy available to you. And it's the most powerful investment strategy for anyone who's got a long time to invest because it will help you actually take advantage of the ups and downs in the market, unlike any other investment strategy. So I'm running out of time. Let me wrap this one up and we'll talk about portfolio rebalancing and then we'll be ready to roll. So remember asset allocation, large cap, small cap, bonds, international. Just know that each of those asset classes go up and down, but they don't really go up and down together. Like for example, typically when the large caps go down, bonds will go up. So if you look at the market today, you'll notice that bonds are up because interest rates are down, and bonds work invertedly to interest rates. So you don't really need to know that right now, but it's a good thing to know. But just know that asset classes, the reason that asset allocation is so important is because different asset classes respond differently to the market changes. When one goes up, another one goes down, and that's an important piece of the investing puzzle, especially when you talk about dollar cost averaging. So my client, Joe, was a farmer. And he had some money to invest. And he said, "Hey, Jim, I want to invest in cows," because he gave me a long list of reasons that cows made sense for his farm. So I'm like, cool, let's do it. And he decided he wanted to invest $100 a month on cows. So Farmer Joe and we set up the plan. It's systematic. Dollar cost averaging is a systematic way of investing. So he's going to put $100 a month into cows. The first month comes along, and guess how much cows we're trading for? I think it's right here. The first month he can buy one cow. Okay, so if you want to go fast, you can just read that, but I don't want you to read it. I want to tell the story. Month 2 comes along, and cows are cut in half. So Farmer Joe gets 2 cows for his $100 in month 2. And you can see as I go through this story, I scribble that in here, but because I'm on my iPad, I can't do it today. So today I'm just talking you through Farmer Joe's story about dollar cost averaging. Month number 3 comes along. Month number 3, you can see that those cows, there are 4 of them because they were trading at $25 a head. So his $100 that month was able to buy him 4 cows. Pretty good, huh? So then month 5 comes along, right? We were month 1, 2, 3, 4. I'm sorry, month 4 comes along. At the bottom of that little loop, there's 5 cows. What do you think that means? It means cows were trading at $20 a head. But remember, Joe's plan, dollar cost averaging, was to invest $100 a month and to buy whatever number of cows he can get for $100 each month. And this month, month number 4, cows are all the way down to $20 a head, and that's when my phone rang. Because Farmer Joe was freaking out, like most people would be doing when the market is way down. He was freaking out. Munchback, he said, "Why am I buying cows? This is crazy." And I had to remind him that it was his idea to buy cows because, and I read back to him all the reasons that cows made sense for his farm. The hide that he was going to be able to sell, the beef that Texans love to eat on the 4th of July, the ribs, the steaks, the hamburger, all of that. And then he did a few other things with cows that were kind of cool. And he's like, okay. He's like, but I feel like I need to sell these cows and get out of the cow business. And I said, wait a minute, Joe. You hired me to be your advisor. I'm going to give you some advice, okay? My advice is that you sell your John Deere tractor and buy more cows, because your John Deere tractor right now, after COVID, is gone up so much that even an old used John Deere tractor is selling for more than it was when it was new, and that's not going to last. It's probably not going to last. So you could sell your John Deere tractor and make a lot of money, and you could go buy a whole lot of cows. Well, then you're going to need a tractor. So maybe just keep your tractor, keep your cows, keep your plan, and keep doing what you planned on doing, because it's working great. Trust me. He didn't like that, but he said, okay, I'm going to trust you. I'm like, good. Trust me. The next month, month number 5, cows are trading at $25 a head again. He gets 4 of them. The next month, month number, what are we on? 6, cows are trading at $50 a head. He buys 2 of them. The next month, cows go all the way back up to $100 a head. And that's when Joe and I had another conversation. He's like, you know what? I'm thinking maybe there's just too much volatility in cows. We're in a pretty good place. Let's take inventory. Let's see what to do. And so that's what we did. We sat down and we did a little math. So Joe invested for 7 months, right? He invested $100 a month, right? So how much did Joe actually invest in cows? 7 months, $100 a month. He invested $700. Okay. And how many cows did he buy? Well, let's just count them. He invested for 7 months, but the price of cows was all over the chart. So the first month was 1, the second month was 2, the third month was 4. How many cows do you come up with? How many cows did Joe buy? Go ahead and post that, if you would, in the comments on Facebook or YouTube, or if you're in the chat. Yen, how many cows did Joe buy? Oh, I thought you were going to give me an answer. Oh, I see some chat now. I still don't have my mouse. I can't see the chat box. Oh, here we go. I'm finding it. Thank you, Yen. 19 cows. You are right. So if he bought 19 cows over 7 months and he invested $700, what would you say his profit is? Or before we say profit, just say how much are his cows worth? If he invested 7 months, $700, his cows, he bought 19 cows, they're worth $100 a head. So how much are his cows worth? 19 of them worth $100 a head. Exactly, Yen, $1,900. So now the question is, what's his profit? Joe wants to know, how much profit do I have? I invested for 7 months. I invested using dollar cost averaging $100 a month. How much is my profit? Because he was able to buy these cows at different prices, but how much was his profit? He invested $700. His cows are worth $1,900. So yeah, his profit, Yen, is $1,200. It's a pretty good profit, as I pointed out to Joe. And the reason that I wanted to share this story with you about Farmer Joe is because that's exactly how it works for you when you set up a dollar cost averaging plan, say, for example, in your 401k. When you start out and you sign up for your 401k, you're going to be selecting different asset classes, and you're going to have good asset allocation in your 401k. And by doing that, every time you get paid, you're putting money into your 401k, and it's being allocated to the asset classes that you chose based on the selection, the options that you have in your 401k. Is that starting to make sense? So now, paycheck after paycheck, month after month, not only are you contributing, getting a tax deduction and getting a match, but you're taking advantage of dollar cost averaging in your 401k. And so what happens over time in your 401k with each of those asset classes is the same thing that happens with Farmer Joe and buying cows. When the market's down or one of those asset classes are just hammered, don't be afraid. Don't worry. Be thankful because you're buying those cows at a fraction of the price and they will come back. And those asset classes, you're buying them at a fraction of the price and they will come back because over time, that's what they do. They go up. And so that's dollar cost averaging. Now I want to highlight portfolio rebalancing because it's similar to dollar cost averaging. And it's the last strategy we're going to talk about today. Portfolio rebalancing. Do I have any pictures? Doesn't look like I need more pictures. I don't have any pictures, I'm sorry. So let me just tell you how rebalancing works. Just think about, instead of buying, let's say that Farmer Joe, I'm making this up as I go, but let's say that Farmer Joe was buying cows, he was buying chickens, he was buying pigs, and he was buying goats. So that's 4 different animals he was buying. And he was using dollar cost averaging on all of them. But let's just say that for some reason, the price of pigs was so low that he was able to accumulate 1,000 pigs. And he has, say, 500 cows, 600 chickens, whatever. And the goal was to have 500 of each animal. But because pigs were so cheap for so long, he accumulated 1,000 of them. Now portfolio rebalancing time comes along, and it's let's say that because the value of those pigs now make up 40 or 50% of his portfolio, and the price of pigs now is very high, just like the price of cows. So what does Farmer Joe do to rebalance his portfolio? Let's just say that pigs are selling at an all-time high and chickens are selling at an all-time low. So his portfolio, instead of being a perfect circle with 4 quadrants, one of those quadrants looks like it's half and the other one looks like it's only 1/8. Okay, just think of a pie and 1/2 of the pie and 1/8 of the pie, and it's supposed to be 4 even pieces. So in portfolio rebalancing, you just put it back in balance, which means you sell some of those pigs that are at all-time highs, and you buy some of those chickens that are at all-time lows, and you rebalance your portfolio. So it works kind of like dollar cost averaging, right? Where you're taking over time, you're adjusting, you're selling off some of the big winners while the price is high to eliminate some of the risk, because those same asset classes are going to come back down. And so you want to sell them while they're high, and you want to buy some of the other asset class, the chickens, while they're low, because they're going to come back up. And then you keep doing that. Portfolio rebalancing works well if you do it every 6 months or so. So in your 401k, you're going to want to put a little reminder on your calendar to rebalance your portfolio a couple times a year. So those are the 4 investment strategies. We're out of time. Thank you for sticking with us, but I'm going to repeat them. First is diversification. Think about Enron and what happened with the people that worked at Enron. Think about Andrea, who was diversified, and Bill, who was not. Diversification is really important. Asset allocation, the single most important determinant of your portfolio's returns is asset allocation. So you need to understand asset classes and what they are and how they work a little bit, because you're going to need to set up your asset allocation in your 401k. You can do it very simply: large cap, small cap, international, bond. There's more asset classes than that, and depending on how many asset class options you have in your 401k, maybe we want to have a conversation. Give me a call. I'll help you figure out a good asset allocation when that time comes. Don't be afraid of it, because once you set up that asset allocation, the next step, dollar cost averaging, is automatic, because you're going to be putting money into your 401k every time you get paid, which means, like Farmer Joe set up the dollar cost averaging to buy cows, when each of those asset classes go down, you're getting a little bit more of them each time you contribute to your 401k, every time you get paid. Over time, it works like magic. So dollar cost averaging is like an autopilot, powerful tool in your 401k in any investment. But it works in your 401k in that perfect investment where you're getting that match and you're getting that tax deduction. And now you have good asset allocation and you're doing dollar cost averaging to boot. And then every once in a while, you're going to want to rebalance that portfolio. Just hit the button and rebalance it. Most 401ks have that button. You just go online, you say, I want to rebalance, you push the button. Do it every every 6 months, once a year. You could do it every quarter. Don't do it too often. Don't worry about it. Just do it every once in a while. Twice a year is good. I hope that helps. Those are the 4 investment strategies that can help you maximize returns and minimize risk. And if you use them, they'll really move the needle on your financial life. Now, next time in the weeks ahead, we're going to talk about types of accounts. And in your plan, your homework, your assignment is going to be to set up some investments in your plan, assuming that you're working full time. I want to leave you with this recommendation, this suggestion. Go ahead in your plan and change your birthday and make yourself 10 years older. Okay? Just trust me. Make yourself 10 years older and go in your plan and set up your 401k and just pretend that you're working your dream job, that you're making the kind of money you would like to make if you got the job you want to get. And then pretend that you're contributing to your 401k, not for 1 year, not for 2 years, but for 10 years. How much money would you have in your 401k if you invested for 10 years? Because then you're going to do some asset allocation in that same account. That's going to be your homework. That's going to be part of your capstone assignment. So start now by changing your birthday so that you're 10 years older, so that you can pretend that you've been contributing to your 401k for 10 years, so that you can go and play around with your asset allocation, so that you can see what your plan will look like in 10 years or so if everything works out the way you hope. And if you do the things that I'm teaching you to do in terms of investing and managing your money. Thanks for watching. That's it for today. I'm sorry I went long. I'm going to close out now. If you have any questions, feel free to ask. Otherwise, I'm going to finish the broadcast if I can get my mouse to work.